Welcome to our annual outlook for 2024, theming the year as Hunt for Bargains. For our highlights, we recap the main events that shaped the year 2023, followed by our expectations in 2024. Insights will be given on how we see 2024's key index target before moving on to our industry picks. Let's start. Almost two-thirds of the 30-share PSEI basket scored lower compared early November's close to end 2022 prices. GT Cap, Bloom, BDO, Meralco, CNPF, and San Miguel clocked in double-digit growth, while MSCI's portfolio rebalancing in February 2023 affected large caps Converge, ASIN, and Globe. Converge prime decliners since Winberg Pincus reduced its block in the telco firm from 16% to 10%. Wilcon, on the other hand, realized slower foot traffic in its old stores. Monde, meanwhile, was taken out from MSCI Standard Index basket from June 2023. Other issues affected the firm, including the pesticide findings in Taiwan for its noodle brand, on top of 13 billion peso losses in 2022 resulting from its meat alternative businesses in the UK. Initial public listings were not spared. There were 3 IPOs that braved the market: Alternergy in March at 1 peso and 28 apiece, Upson in April at 2 pesos and 40, and REDC or Repower Energy in July at 5 pesos per share. Of the newbies, only REDC and Figaro Group finished green. Moving on to real estate investment trusts or REITs shares, Citicorp REIT booked gains ahead of the backdoor of parent firm Citicorp Renewables and Vista REIT. Somehow, higher vacancy for office spaces weighed on other REIT shares, weighing on PhilREIT, RCR, and MREIT. In terms of net foreign flows, BDO, Jollibee, and GT Cap led net inflows. BDO benefited from International Finance Corporation's investment in its blue bonds, while Jollibee recovered from its investments in Coffee Bean and Tea Leaf, as well as Smash Burger, while streamlining its portfolio of restaurant assets. GT Cap, lastly, advanced from the buyback of shares in Metro Pacific Investments or MPI. Net outflows were visible for Globe, TEL, and ASIN. For all shares basket, foreign funds trimmed their holdings in MEG, Robinsons, and AP, and went overweight for Union Bank with the consolidation of Citibank's consumer lending business. Keeper on its foreign investments in Spain's liquor producer Bodega, and Abacor Holdings on its foray into renewable energy. For IPOs, foreign funds went underweight in Monde and overweight in All Day and Figaro. For REITs, net outflows for a REIT and RCR, and net inflows for Vista REIT. 2023 was also marked by active share buybacks, especially for select stocks with budgets to allot. Those that have been successful in positioning on weakness and have since merited improved pricing were AEV, ICT, and Price Corporation or PPC. Meanwhile, there are still stocks whose current market prices are trading at a discount compared to treasury acquisition costs that include Medic, Costco, and RRHI. For our economic review, with third quarter GDP coming out better than estimates, we have upgraded our 2023 outlook from the earlier 5.2% to 5.5%. Fourth quarter GDP may still be challenged by higher consumer prices as well as seasonal pickup in imports with the Christmas spending season. For 2024 outlook, we present a base and uppercase scenario dependent on the timing of monetary easing measures, which has largely been tied to inflationary trend. Our base case GDP growth of 5.3% considers monetary easing in early 2025, while the upper case of 6.3% considers loosened monetary policy by second half of 2024. Consumption strength will rely on enhanced business activity, especially with employment at 96% as of November 2023, bringing unemployment to 4.2%. Remember that during the pandemic, unemployment was a significant recovery from 17.6% in April 2020. On the fiscal front, government expenditure growth is seen to gather pace as construction works accelerate on road, bridges, and airport infrastructure, food storage and logistics, as well as electrification initiatives. On investments, sequels to President Marcos Jr.'s state visits is something to look forward to, yielding an estimated $24 billion in pledges. Also, Maharlika Investment Fund is seen to provide funding support specifically to infra projects. Lastly, apart from improving business through the setup of green lane services for permitting and licensing, the Trade Bureau has initiated its Supply Chain Control Tower initiative through the setup of distribution hubs, cold storages, market linkages, and technology. The challenges, meanwhile, will be on implementation of tax and non-tax revenues to narrow the budget gap, as well as trade-related factors based on the economic status of the Philippines' trading partners. On quarterly GDP trend, 2022's main highlight was the 300 basis points increase in the Federal Reserve rate, while the local central bank effected 350 basis points increase in the domestic rate. In 2023, the pace of increase has already slowed to 100 basis points for the Fed rate and similar 100 basis points for local interest rates. The local rate hike was done in February and March, and an off-cycle hike last October 2023. Moreover, BSP lowered bank's reserve requirement ratio by 250 basis points to 9.5% for large banks last June. Externally, 2023's positive theme was WHO's official declaration in May that COVID-19 is no longer a global health emergency. This went parallel to challenges from the capital crisis in March by SVB Financial Group and Signature Bank, followed by UBS's buyout of Credit Suisse with liquidity support from the Swiss Central Bank. 6 months later, the Israel-Hamas conflict in October 2023 caught global markets' attention. With interest rate cuts becoming narrower, let's take a review how local authorities fared in controlling inflation at home. We revisit the slide presented mid-2023 on countermeasures to challenges to inflation. This state, unceasing efforts continue to battle the forces stemming from climate change challenges to transport and utility rate increases. And as such, from a peak of 8.7% in January 2023, consumer prices have softened to 4.1% as of November. We see inflation averaging 6.1% for 2023 and ease to 5.7% in 2024, assuming efforts continue in achieving food self-sufficiency and limited disruptions are felt from trade-related imbalances. Note, however, that external challenges remain present, with global food security likely to gain ground as regional trade cooperation are underscored. In 2024, weather experts have flagged the extension of El Niño episode at least within first half of the new year. Second, the spotlight will remain on inflation trend as well as the timing of possible monetary easing consideration from the Federal Reserve either in second half of 2024 or early 2025. Third, officials are seen to make their goal to pacifying geopolitical rifts economic impact, especially on sequels to Ukraine-Russia as well as Israel-Hamas conflict. Lastly, global investors would be on close watch to OPEC Plus measures towards energy security against energy transition to green energy. Looking back in early 2022, the PSEI breached 7,554, while the lowest came in September of that year at 5,740. This puts the midpoint at 6,600, which we feel would be the new base moving towards 2024 as gauges build up on higher lows. With PE multiples trading cheaply at 12 times to 13 times forecasted profits, the market's key target would be at 7,300 to 7,400. This places PE multiples to roughly 18 times compared to the peak of 2022 times pre-pandemic. And with two-thirds of large caps performing weaker in 2023, as earlier mentioned, there is no other direction but for a recovery for these shares in 2024. The key catalysts are easing of monetary policies and hunt for higher real returns through revenge investing. Speaking of financial liquidity, let us look back on several enterprises that floated their plans to list in the exchange but did not make it for 2023's timing. It is expected, however, that some of these companies would list for 2024, among which includes GCash for Globe, SM REIT, Enrique Razon's Infra Arm, Prime Infra, Metro Pacific Hospitals, among others. Metro Pacific Tollways, meanwhile, was moved to 2025. The year might also create positive energies, being the year of the wood dragon. Considered mythical, auspicious, and supreme creature in Chinese mythology, dragons are considered to bring prosperity. The element of wood signifies growth or progress in its early years of development, leading to prospects for gamer changers. And wood is also the mother fire element, thereby igniting passion, innovation, and creativity. Its energy side signifies those associated with green, life, and vitality. And among the sector stars that fits the wood dragon element are those in technology, such as artificial intelligence and robotics, renewables for green energy, digital assets and cryptos for digital banking, gaming, water, tourism, agriculture, fashion, and media and entertainment, as well as mining.
Moving on to our sector calls, 2024 would be overweight on property, banking, gaming, and power, with potential value play on select holdings. A handful of stocks made it among gainers for the listed banking shares, led by East West, BDO, and China Bank. With higher benchmark interest rates on the backdrop, investors turned selective on those with solid gains on net interest margins or NIMs, improving prospects for dividend plays. UBP led decliners ahead of integration costs associated with the consolidation of Citibank's consumer business. SECB was weighed on weak quarterly turnout and modest margins, while some investors trimmed their holdings on BPI and Metrobank, despite being resilient in their earnings performance. NIM growth for 9M 2023 ranged 41 to 80 basis points, leading to earnings growth of 10% to 60%. This led to high return on equity, with double-digit booked by BPI, BDO, Metrobank, East West, and China Bank. Listed banks' non-performing loan ratios were in single-digit, while loan growth ranged flat to as high as 27%. Most banks in this list hinted for possible slight uptick in NPLs in succeeding quarters from consumer loan segment, but they do not see this as significant during the pandemic. Enough provisions have already been accorded, so provisioning is seen to remain stable. Core lending growth is seen to be at par with GDP outlook. With interest rates still elevated, consumer lending might see some growth, albeit at a slower pace compared to previous quarters. NIM expansion may be sustained until at least first half of 2024, as consensus builds for rate easing in the second semester of the year. Price-to-book value guidance appears cheap compared to historical averages, with discounts of current prices ranging 26% to 56%. Digital banks, meanwhile, will be part of disruptions in the banking industry, given the competitive deposit rates they offer, client accessibility, and convenience. However, we see traditional banks staying in the lead, given customers' personal preference in their mode of banking. Traditional banks will compete on the merits of sustained investments in digitization as they carefully traverse the field of e-wallets. For stock calls, our views are reaffirmed for banking leaders Metrobank, BDO, and BPI. MBT is trading at 39% discount to historical mean on price to book value with target price at 75 pesos per share. BDO's high return on equity and well-balanced loan mix will provide stability to operations. BDO target at 160 pesos per share. And BPI, given its synergy with Ayala Group's GCash as well as wider network reach through Robinsons Bank acquisition, BPI target at 123 pesos per share. For potential dark horses, Security Bank might be worth looking into, given the stock's 53% discount to historical mean price to book value. Long-term upside may be aided by its aggressive retail banking push. Another is East West with its superior valuation at just 0.29 times annualized 2023 book value per share, a huge 42% discount to historical mean and the second lowest among peers at negative 54%.
The gaming industry has taken a sharp recovery with V-shaped trends on market prices. Key gainers were Plus, Lotto, PLC, Bloom, and PHR. Bloom saw strong year-on-year improvement in its gaming business for 9 months, driven by improved foot traffic for its mass gaming, while VIP played catch-up. Plus, meanwhile, benefited from the success of its online channel, Bingo Plus, as well as the modified outlook ODCU owners. Pagcor, on the other hand, guides online gaming receipts to reach 24 billion pesos by end 2023, approximately 9% of total GGR. Looking closer at Pagcor's data on GGR, we see on the rightmost side 9 months GGR of 205 billion pesos, 38% higher year-on-year. This jump is attributed to consumers' zest for leisure, which is seen to be sustained on the back of new economic normalcy. For full year 2023, Pagcor sees total GGR to finally surpass pre-COVID levels at 273 billion pesos, higher by 27% compared to 2022. For our stock pick, Bloom is worth looking into with potential target of 14.24 pesos per share. Bloom's strong results in the first 9 months, coupled with its ability to ride with GDP growth, makes it an attractive investment in the gaming space. Upside looks promising with incremental earnings from the opening of Soler Resort North early in 2024 as well as its Cavite lot purchase that will be transformed into a golf and casino hub. On share price comparatives, majority of property shares were lower, especially with major stocks SMPH and Ali affected by MSCI and FTSE rebalancing. 3 segments are in retrospect: residential, mall, and office spaces. Under residential, some listed firms continue to report cancellations as of September 2023, but not as alarming as in previous quarters, which is a result of flexible payment terms offered to buyers. This segment may continue to reel on elevated interest rates, but may merit consideration as borrowing costs slide for the second semester of 2024. For malls, this category benefited from improved foot traffic, leading to higher occupancy, share in tenant sales, as well as removal of rental concessions. Office spaces may remain challenged as the influx of new supply in 2024 might lift current vacancy rates. As of third quarter, vacancy was around 19% and is seen to grow to 21% in 2024. The saving light might come from growing demand for business processing outsourcing or BPO spaces, especially in key areas in the metropolis that are closest to transport hubs and residential enclaves. Here is an update of Real Estate Investment Trust or REIT's performance as of 9 months 2023. From 2022's simulated dividend yield, annualized 2023 dividend yield range has improved to 7% to 10%. Nearly all listed REITs are trading at a discount to their net asset value per share, ranging 5% to almost 70%. Upsides in 2024 will rely on new asset infusions for REITs, especially those with healthy stream of recurring lease income. Meanwhile, hospitality will be a key theme for 2024's property sector. Tourist arrivals in 9 months reached 4 million, 51% higher compared to the entire stretch of 2022. The local tourism bureau sees this number advancing to 4.8 million this year. The same was magnified in listed stocks hotel operations, with growth rates ranging at 37% to 134%. Provided there won't be any resurgence of health-related issues globally, the hospitality business is slated to ride on tourism's growth in 2024 as travelers' zest for leisure is magnified. Moving on to our stock calls, RLC is trading at 70% discount to NAV with its Bridgetown project providing top-line revenue sources. Target price for RLC is 22.75 pesos. CLI is another stock trading 50% discount to NAV with prospective boost from its Davao Township and reclamation undertaking in Cebu. CLI TP is at 3.61 pesos. Ayala Land has benefited from brisk mall and commercial lease operations, trading 50% lower to NAV. Ali's target is 38 pesos per share. For REITs, MREIT's upside to target price of 60.20 pesos will ride on upcoming asset infusions from parent Megaworld. RCR on the other hand is strongly backed by stable occupancy and that the stock's quarterly dividend has been higher quarter on quarter.
For power shares, 4 listed shares advanced: Repower, Meralco, First Gen, and AP. Power generation and distribution earnings for 9M 2023 were upbeat, backed by higher rate rebasing plus favorable rates at the wholesale electricity spot market or WESM. Red Sea had a favorable debut, supported by its hydropower plant aspirations. ACEN faltered following the stock distribution of ACEN shares acquired from AC Energy and Infrastructure Corporation. The plus factors for the energy sector is on 5% compounded annual growth rate or CAGR outlook, supporting distribution for the demand side and generation on the supply side. In support to the nation's transition to green energy, RE requirement would augment demand for new capacities, with 86% of RE capacity targeted by 2030. For challenges, thermal plants margins remain anchored on oil price volatility. Among the risks seen for operations include vulnerabilities to plant shutdowns and higher operating and maintenance charges. You will note in the table that key major players within the energy universe are trading at attractive price-to-earnings multiple, with discounts at 27% to as much as 59%. Government's RE roadmap will require 86% expansion in RE capacity, giving power generation players wider legroom to expand. This covers roughly 6,200 megawatts capacity until 2026 to reach the 11,600 megawatts requirement under the Green Energy Auction Program or GIAP. Here are our power stock goals. AP's solid 9M 2023 results will be supported by 218 megawatts target additional capacity for 2024, synchronized with its aim to achieve 3.7 gigawatts additional RE capacity by 2030. Forward PEs are 7 times compared to 14 times historical mean, with target price at 45 pesos per share. FGen is another cheap yet powerful play in the generation sector. Target is 24 pesos per share, riding on its unfolding LNG terminal story. Meralco's foray into generation will widen earnings sources from traditional distribution. This includes equitized earnings from its upcoming buyout of majority block in SPNEC. ACEN is among energy plays that is worth looking out for, given the company's RE pipeline locally and overseas. ACEN delivered 59% growth in earnings for 9M 2023, marked by reversal from net buying position due to shutdowns last year to net selling position for 2023. Meanwhile, valuations are currently at a premium, although a different angle might be arise given its 20 gigawatts RE capacity by 2030. We are also monitoring developments in SPNEC as it has good long-term potential given the entry of Meralco, as well as its planned acquisition of its parent's plant assets and pipeline projects that could reach up to 10 gigawatts of potential solar capacity. Conglomerates or holding firms was not spared from the brunt that weighed on the general market. Only a handful rose: LPZ Group, GT Cap, and San Miguel. GT Cap's driver was the tender offer and the delisting of Metro Pacific Investments, which was deemed a good addition to GT Cap's portfolio. SMC meanwhile raked in gains, now considered a solid infrastructure play. The stock benefited from toll road tariffs that were implemented this year. Meanwhile, JGS, DMC, and AEB led decliners. For JG Summit, while airline unit Cebu Pacific has shown recovery, this was offset by continued losses from its petrochem business. For DMC, operations were affected by weaker coal prices affecting mining unit Semirara Corporation's income contribution. Holding firms have come off from their historical PEs with price discounts at 8% to as much as 79%. Accumulating these shares provide encouraging upside potential, especially for investors seeking for long-term returns. Prioritize key stocks armed with solid financial results and prospects, such as GT Cap and SMC, and those exposed to sectors that are seen to provide growth for 2024, such as AC, SM, AEV, and AGI. To highlight, GT Cap has the best valuation in terms of discount to PE, with its key strength in automotive, banking, property, and stake in Metro Pacific Investments. AC, meanwhile, will ride on its key pillars in banking, property, telco, and power, with promising returns from emerging units in health and logistics. SM is a resilient giant anchored on the growth of its core banking, property, and retail operations. SM has also opportunities to unravel for logistics as well as power generation.
Quoting Michelle Obama, "Don't be afraid, be focused, be determined, be hopeful." And that's the key reason why the Year of the Wood Dragon is timely for being empowered. Liquidity in the financial system remains ever present, and as trading opportunities arise, when they go low, we go high. Thank you.